Welcome back, everyone, to our weekly market update and review of what's going on around the world as the economy starts to reopen again. As always, my name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks everyone for joining us. Before we get started today, I have to apologize if you do hear some background noise due to some poor scheduling with the family. I've got two dogs running around the house, so if you hear anything, and delivery's coming to the door, so they're prompt to let me know that something's arrived. So I do apologize if there's anything in the background. We are starting to go back into the office, and we're going to talk about that as it pertains to the COVID. So in the coming weeks, you might see some of our recordings coming to you from our downtown office. That being said, before we get into things, as always, information we talk in these videos, talk about and cover in here, whether it be general market information or specific stock details or equity details, is not meant to be advice. Do seek the advice of a professional advisor or do your own due diligence before taking on any strategy or any positions in your portfolio. And we do try to keep the information as up to date as possible, but it is constantly changing. So again, do verify before acting upon anything there. If you do have any questions, always feel free about anything we talk about today or anything market, portfolio, financial plan in general. Feel free to reach out to us. If you're on the live recording of this today, you can do it through your Q&A icon on your screen right now. Your video and audio is muted, but you can click on that button and you can type us a message. We'll either answer your question here today if time permitting. Otherwise, we will definitely follow up with you in the next day or even this afternoon with your answers. If you're watching this on the recorded version, just email us. If you're on the recorded version, you should see our email down below, or you can always go to mikeonmoney.com. And that's our contact page on our website. You'll find all our contact information there, as well as other videos that we do. We do usually one on Friday, a deep dive into specific topics. And of course, every Tuesday we do this live update of the markets and what's going on around the world. So let's get right into things. Where are we at with the economy and the COVID transition? Well, this week, upcoming week, we're looking at the Chicago Fed National Activity Index. So that's kind of your economic index as to how things are going with the reopening, how the economy is restarting. So that'll be an interesting number to see. Just we don't expect it to be a very positive number. Of course, the economy has been shut down for the better part 2 to 3 months. So, but we'll get a better indication of how things have been more precisely, rather, of how things have been affected. We're also looking at existing housing sales, how that's been impacted. So far, we haven't seen a lot on the pricing. There's been some weakness showing up in the pricing, but not as impactful as we probably will see it in the coming months. But a lot of volume down, of course, as people self-isolate, not out there shopping. The Federal Reserve have their closed door meetings this week, and we're also seeing the SEC chair having discussions about market structure changes and how it can better suit if this should ever happen again. Also coming up with the coronavirus, of course, the White House is preparing for a second wave. The numbers have not slowed down in the United States. It's almost like there has not been not necessarily a second wave. We haven't really seen a slowdown on the first wave. In fact, we'll dive a little bit more into the world numbers, but we actually saw the largest increase in single day infection rate yesterday, I believe it was. And of course, some surge numbers in certain states in the US where Florida being one, would be an example of a state that never really shut down, certainly not compared to other countries or other areas. And we're seeing in Arizona and other areas of the United States as well. So what will that mean? Well, the White House is trying to figure that out. Of course, there is a push to not shut down the economy again, and whether they they handle a different way. Now, when we talk second wave, we mentioned this last week. We are fully expecting, the market is fully expecting somewhat of an increase in infection rates as we reopen. Of course, even in a controlled reopening, we are introducing more people to interact, whether it's small groups or more people going to stores or restaurants. There is more contact. So that means there are going to be more infections. The goal here is to keep that curve flat, which means that the overall spread rate doesn't increase. So we do fully expect to see some more infections or them to go back up, but certainly not new peaks or new highs. And as what we're seeing in Canada, especially BC, we're doing quite well with that, but we'll take a look at those numbers. China has halted some Tyson chicken shipments over concerns around the COVID virus. Not surprising, we're actually seeing that also in North America. Certain, whether it be restaurants or in the food supply chain, where the employees are having an outbreak, and whether the company themselves or their supply chain shutdowns or reduces orders from those companies or from those plants, and that's going to be a problem for the supply chain as we reopen. We've seen it in the car sector, we've seen it in the food. As I mentioned, we sell in the restaurants. So it's straight through basically from manufacturing or production, straight through to retail. So this is not surprising. Obviously, a lot of pressures when it's happening between countries, but it's something we'll keep a very close eye on. The US corona death toll approaches 122,000. It's actually gone through that this morning. Of course, I'll have this morning's updated numbers here in a couple of slides. And that's just as New York starts to allow companies to reopen their offices. We're seeing that again globally, offices reopening. For the most part, I think you're going to find the offices reopening on a limited basis or a certain number of staff per day basis. I know that's we're doing, and many other companies in Canada are doing. Companies haven't really quite figured out the social distancing in an office environment yet. Obviously, having everyone go back all at once is probably not in the cards in the next short term. A lot of companies are reassessing the work at home, which positions could make that potentially permanent, which employees might make that or be able to make that permanent. And obviously the office space, how much office space is needed and what kind of spacing they're going to have in the offices. And that's straight from industrial to the general working offices, whether they're going to need more square foot per person, but how many people do they need to have in the office? And that's kind of a work in progress. Companies don't have the expertise, and there's certainly not a lot of guidance, especially in the US, about it. So it's going to be a little bit of trial and error, I think, in that front. Vaccine efforts continue. Some of the research coming out of the vaccine efforts do have concerns around the more vulnerable groups like older adults. And this is just around the how long the vaccine lasts for, if it's seasonal, if you can reinfect, or can you still get it, but in a more milder format. All this is trying to be worked out, and they're focusing more on that, the more vulnerable group, as to how the vaccine will work and whether it will protect them. And coronavirus need for cash. We've talked about companies really needing cash. They've been dipping into their credit lines, shoring up new credit lines, taking advantage of government stimulus, but also they're now re-looking at their investments, and we'll take a bit deeper look at that in a second here. So insights and analysis, what's going on? Well, there's a bit of model misbehavior, especially in the banking system. If you can imagine banks, how they manage lending risk to corporations and to individuals, it's kind of all being thrown out the window here, because they've never seen a complete shutdown. We've seen industries or sectors go through difficult periods of slowdowns. But we have a mix of just global shutdown and unprecedented government stimulus packages from around the world. Shoring up debts, giving guarantees, giving stimulus cash. Banks are really a bit of a loss on the lending front, especially for the kind of on the line companies or sectors. So it's really creating a lot of problems in the banking sector. And if you take a look at the bank's performance, both in Canada and the U.S., they've not really bounced or recovered or moved the same way as other sectors have. And that's a little bit of investors having some uncertainty, but also the banks themselves not knowing how to give guidance as to the write-offs or the write-downs that they may be facing or may not be facing. So we're watching that really closely as the banks figure that out. Inflation may be turning its ugly head. We're seeing areas as like gold, we're going to talk about moving up, forest, property stocks, real assets, inflation-linked bonds. We're seeing cash flow into those as investors are looking at those as safety, but also with all the government spending, is that going to mean inflation? We've seen inflation very low, obviously kind of even below the 2%. Of course, the target is 3% or lower, or between 1% and 3% is the healthy range. We've enjoyed decades of it kind of in the below 2 range. And now are we looking at that breaking above the 2 and having to see interest rate hikes potentially in the next couple of years to head off inflation to keep it below the 3 numbers. So keeping a very close eye on that. The pandemic is also as we've talked about, pushing technology, and one of the areas is the bond market. So the bond market is traditionally, if you're not aware, about three to 4 times now the volume, dollar volume, that the stock market is. It's a massive market. It still had worked for the most part, not completely, on a little bit of the old school trading platform where bond traders would call each other. Certainly there was technology being used as far as inventories and finding out who had them, but really the main trades, the main pricing, especially for the volumes, was done over the phone. That's of course with people working at home, people not being able to be in the office, has pushed another part of the industry towards technology. And it looks like it's finally shifting to an electronic base, which will mean better opportunities, especially for the retail investor, more access to where the inventories are held, and also pricing, because pricing was often done, again, between traders. So it was the quality of traders, their contacts, their abilities to get access to that inventory, and also being able to move volume meant better pricing. So with going electronic, obviously we'll give access to that. Good for sellers, good for buyers, as it makes it much, much more liquid. Other headlines, or diving deeper into some of the headlines that we've already talked about. To mention, the U.S. approached 122,000 on their death toll as of this morning. New York is reopened. India's death toll rose by 445, a highest single daily tally since this all started. And then it's now the fourth most affected country, just behind the U.S., Brazil, and Russia. The cash needs for companies, as I mentioned, is growing, and we're now seeing not just using the credit lines or lending power from the companies, but they're actually selling off positions in the firms, so non-core parts of the company, selling those off to free up cash, to free up cash flow. Ease up the balance sheet. Companies abandon expansion or growth plans as all this happens. So good for some companies who will allow them to acquire and really have to rethink the company's growth strategy and income strategies as they give up on some of those growth plans that they had. We've seen in the raw material a rally happening, not just in gold prices, but in oil Now, again, oil coming off a very deep bottom, a bit of a rally. Copper's also moving. Again, this is a little bit of enthusiasm around the reopening of the world economies. We're really going to have to see if this is just that surge that we talked about, that pent-up demand being picked up, or is this going to be a continuous a growth curve? Very likely we are going to see that pent-up demand surge, but where it's going to settle afterwards is what we have to keep our eyes on. Of course, the protests around Black Lives Matter continue to spread, not just in the US, but around the world. More and more people getting involved, more and more things really being examined, more and more long-term processes that maybe have been pushed aside and overlooked, and some long due change will likely come out of this as the depth and breadth of the protest and movement continues to gain speed. We see more stocks drive the rally outside of technology, and we're going to dive into those sectors a little bit deeper here today, and also look at some individual names and just take a look at what's really moving and why currently. Huawei's dominance in the 5G area is starting to be threatened, and this is due to last year the US putting restrictions on chip manufacturing in the US, and also where they can be used. So this is putting Huawei in a bit of a tight bind as far as getting access to the technology they need to expand. As I mentioned, cash is still king. We're still seeing companies hoard their cash and really looking at bracing for several more months ahead, especially as the threat of a second wave or continuous wave gets higher and higher as we move along here. We're also seeing the stocks move on these stimulus packages. Of course, the rebound we've seen has been mostly on the stimulus packages. And now the market's almost waiting for a second round of stimulus packages. There's some pushback, though, in the Senate in the United States. Republicans are kind of caught in between two areas. One, of course, it's an election year. You do not want to go into recession. You do not want to have a bad stock market for the economy. But at the same time, the conservative supporters are very concerned around pumping more cash into a stimulus package. So there's this fine line they're walking, and if the market doesn't get their second stimulus package that they're pricing in, it could mean another pullback there. Vaccine efforts, as I mentioned, is focusing on the elderly as obviously the more vulnerable group, and we've seen that, of course, with other viruses, the flu being an example, where older and younger people who are more at risk get the vaccine first. So a lot of focus being put around that. And of course, we had Trump's rally in Tulsa. We won't dive into all the news around that. It was what it was, and he's headed over to Arizona and Wisconsin as he continues his campaign process for the re-election in November. So where are we at around the world? Well, we're quickly approaching the 10 million infected cases and 500,000 on the total victim side. Those numbers just keep growing, have not overly slowed down. One thing I'll say about this chart, since we've been doing these, I've always cut it off at Canada. I'm happy to say, though, that I've had to keep the chart to fit on one slide here. I've had to remove some countries that the reporting is still fairly inconsistent out of there. Just because the list would be too long to get all the way to Canada. That means Canada's doing a good job, and we keep falling backwards down that list as other countries move up. So Canada's in good shape. We are over the 100,000 mark and sitting just shy of the 8,500 on the death side. Of course, the US is through 122 and 2.4 million on total cases. The US has not, as I mentioned, not really slowed down on the average number per day on the infected and deaths. And of course, there is some push in the government in the US to slow down testing which of course will not change the infected rate. The numbers, of course, might stop going up just because you're not doing as many tests, but it won't help with anything when it comes to stopping the virus. So where's the economy at? Where are the markets at? Wall Street saw some gains as investors are looking past the current economic impact. As I mentioned, they're really looking for more stimulus. The US dollar dropped a bit. Of course, it had been surging on uncertainty, that flight to safety. As people get a little bit more bullish, the US dollar will show a bit of weakness. We saw gold move up slightly. We'll go deeper into those numbers. And the treasury yields were steady. Oil will go in deeper too, but it actually rose a bit. But keep in mind, again, we'll get deeper into the oil here, but this is oil moving not on an increase in demand, it's tightening the supply. So I don't want to say it's a bit of a fake market, but it's just producers turning off the tap. The oil's there. The US is just one big shale field. They can turn that on at any time if they need to. So we're really not seeing a recovery, if you will, in the demand side of things, and that's really what we have to see for a longer term oil recovery. Coming up in the U.S., as I mentioned, the Fed chair is getting together. They're working on how to build a resilient workforce. So this is not only around the current pandemic. It certainly is going to focus on the current pandemic and how the workforces can withstand the slow economy and recover, but also for future ones. What needs to be put into place? What changes have we learned from all this? And how can companies and the workforce be better prepared for the future? So I think very important work. In fact, if you put really good strategy around that, if you just think about the stimulus packages that went out quickly and promptly and hit all the areas it needed to shore up the economy, even for the short term, a lot of that was learned from the 08-09 downturn that we kind of went into blindly. This time they had experience, they knew where the problems were going to come up. So really looking at the workforce, looking at the economy, looking at companies and how they can be better prepared moving forward, I think is a worthwhile effort. The U.S. Commerce Department is also expected to release current account data. Very likely to see a deficit, of course, about 100 billion. We've got nothing's really changed, and of course, this is coming off May, where the economy wasn't really reopened again. Oh, sorry. Let me see if I can get us back. Apologize. The U.S. economy wasn't really reopened in May, or at least just the beginning, so we wouldn't see any improvement there. Microsoft and industry leaders are doing a virtual conference in Copenhagen just to talk about democracy, digital, and pandemics. Again, how companies are dealing with not just the pandemics, but how digital can help, and obviously around the politics, which are very much involved in all this. So the U.S. top news, Europe is threatening to go ahead with the digital tax. And if you haven't been following this, so this is the EU is looking to tax digital companies that act, of course, there's no borders. If you look at Google, Amazon, and Facebook and others like them, EU is looking to move ahead with the global tax, digital tax, and that's after Washington quit the talks, potentially stoking another trade war with the EU while they're still in a trade war with China. EU has also advanced talks with Johnson & Johnson, the U.S. Pharmaceutical company, for the distribution of the vaccine, or the potential of a vaccine. So as we get closer and closer, again, once it's developed, how's it going to get out there and what companies are going to be involved with that? So EU is in talks with Johnson & Johnson on that front. Apple is switching, made a pretty big announcement on the tech front. They're switching to their own chips. So they've been using Intel chips. If you own a Macintosh computer, a Mac, a laptop, desktop. It has an Intel in there. Now they're switching to their own chip, and not surprising, although a fairly big shift in the sense that Apple has always had a pretty closed architecture to the technology. Delta Airline is opening flights to China, so on June 25th, coming up this week, and that's the first U.S. airline to restart flights between Canada and China since February. Google's U.S. income is and revenue is taking a hit due to the pandemic, and that's just going back to the trend with companies shoring up cash. One of the easiest areas to cut is advertising. So no surprise there. We're probably going to see that in other, whether it be printed media or Facebook, which also relies a lot on ad revenue, and YouTube. That trend will be across the board. In Canada, Canadian resale sales are expected to have plunged about 15% for April after a decline of 10%. Again, not a big surprise. May, which we don't have those numbers yet, are expected to decline as well. Sales excluding auto are declined 13.5% in April, and expected after a decline of 0.4% the previous month. May will likely be the worst month of them all, with everything being closed during that time period. Canada's wholesale trade was down a bit higher than expected, 21.6%. I believe the estimates were just shy of 20%. And this is just with everything being shut down. Canada's not reopening the borders anytime quickly. I think the date was July 21st. It's been pushed out to. In fact, I saw a very interesting map, and it showed all the hotspot, kind of the infections all through the U.S. By size, based on the size of the circle on a geographic map, and then the Canadian circles as well. And you really saw a lot of red along the U.S. border, and so not surprising, Canada is being very cautious about reopening that. And we've even seen, I was reading that several Americans were given, I believe it was $1,500 fines that they had lied and gone through the border, saying they're going to Alaska, but they just went for a weekend tourist trip into Banff, and they were fined as they were caught there hiking. So, Canada's keeping a watch on that border and keeping it closed just to keep the numbers down, again, to prevent that second wave. Canada needs a targeted response to prevent future wave. And of course, this is, again, all the plan and taking everything that we've learned. So as we reopen, of course, as mentioned, we are going to have some outbreaks. It's really going to be around containment, taking quick action, and also tracking those infected, and new technologies are coming out on that front. Bank of Canada quells the sub-zero rate talks. So Bank of Canada, of course, getting as they meet and dealing with a near zero environment, the next step could be a negative rate or sub-zero interest rate. Canada has said that they're not going to go that route. In fact, they're talking about the next hike, likely to be in 2022. As the economies recover in later 2021. Oop. Sorry. There we go. On the foreign exchange market, we did see the pound rises. The UK looks at reopening. As they start to reopen, they're looking at the economy to rebound. Although the longer term outlook for the UK's market, or the pound rather, is still slightly negative. Canada rose again a little bit from last week, and that's on the weaker US dollar we've already discussed. Sorry, I'm having problems here with the mouse, but we'll get through this. The commodities. So we saw oil break through 42, although the futures were flat. So basically the market's saying they don't see a long-term or a real need for increase. And again, that just goes back to the fact that there's been really no increase in demand, and it's only been the supply that's been turned off. We're going to dive more into that sector here in a couple of seconds, but we're probably not going to see much in ways of oil rally probably for another year or so as we wait for demand to come back. Gold, we saw a slight increase, and that's again just inflation hedge as buyers move in there, and also concerns about a second wave as buyers move into gold as a safe haven. We did see that outbreak in Beijing. Of course, they went immediate lockdown, and again, that goes back to what Canada's thinking. Maybe not that severe, but what kind of actions they can take, how they can quickly respond and contain a potential outbreak. And Beijing has managed to tame that, and as that eases, we saw the markets recover from that as well. Sorry, just. Okay, so let's dive into the specific sectors and what's going on in the stock. So let's talk sectors first. What can we expect coming up here? Oil and gas, as I mentioned, the strategy to take with oil and gas is definitely sell on rallies, buy on weakness. This is not a sustainable. Any of the rallies we're seeing are not sustainable in this area. There's too many countries that have drastically cut back supply. And a lot of these countries really rely on oil as part of their GDP, part of the revenue that they need to support their economies, and they won't be able to maintain these cuts forever. And we've seen in previous agreements, certain countries break those commitments and increase their supply. Even if it brings down the price, because even at a reduced price, at least they're getting revenue coming in. So if you're looking at the oil and gas sector and you manage to make some money on the rally here, I would take those profits and wait for the next pullback if you really like the sector. It's not really a buy and hold strategy at this moment. As I mentioned, there is currently no economic strength to really warrant a long-term push. On the pharmaceutical front, here's a sector we can look at. Again, some really good growth coming up here. Not just when we talk about vaccines, but there's a lot of pent-up demand on other treatments, medical conditions that have been non-life-threatening, that hospitals have pushed off treatment or pushed off. People have not gone in to be diagnosed. And as people start to go back to the doctors, as the hospitals open up again for surgeries, as they open up for regular treatments, that pharmaceutical pent-up demand is going to start to surge. So it's a really good sector to be looking at. I think there's a lot of opportunity there. Technology we've talked about for the last several weeks. I still think there's some really great names in there. We're going to cover a few of those. I would be very cautious on technology though right now. Here's one where it's probably got ahead of itself. If we really graph out either the companies or the sector, here's a sector that's probably a little too much hype, a little too much speculation, maybe across too many different names, and it might be worthwhile taking some profit out of this sector, wait in for just a natural pullback, not necessarily that these companies are bad, just they might have gotten a little too far ahead of themselves on the pricing front. Materials we talked a little bit about. Yes, we're seeing in copper, we're seeing a push. We're seeing things, as I mentioned, oil in there, but gold as well would be in that category. I do like it. They're good long term. I'd be a little cautious around the base metals, as I mentioned, kind of copper. It's really going to take a stronger economy to maintain those prices, to maintain that. The gold, I think, if you've got it, it's a really good hold. It's, as I mentioned, it's an inflation hedge. It's a good area to keep in the portfolio and just leave it there. If you do see a big rally, again, maybe take advantage, sell into the rally, and wait for another natural pullback. and take advantage of it. Real estate, we've talked about the REITs, the trusts out there, maybe individual real estate. You know, real assets is always very powerful in the portfolio. I do not want to say this is not a great opportunity. In fact, I think it's going to be a really great opportunity in certain areas. I did a deep dive into the REITs video. You can find that on our Mike on Money page, mikeonmoney.com page, or on a YouTube channel. So there's a lot of different areas to real estate. Of course, we have industrial, which is my favorite. It's always been my favorite for years. Industrial, you don't get the huge gains in capital gains necessarily. Sometimes you get natural growth. You get a great secure income flow from it. Apologize here. You get a great natural income flow from it. The long-term tenants. Just so many good things about industrial. But what are really the real concerns we have, of course, is retail, right? Your stores. We're not close to near the bottom in that area. There are some cheap REITs out there, but I would still hold off for a little bit. We're going to have a very big excess supply for a long time in that area as more and more retail closes or downsizes. Office space, same idea, business office space. More and more companies are announcing, as we've talked about at length, of reducing their staff, more work at home, just a smaller footprint, especially in the downtown cores. More and more they're realizing they can work remotely. Maybe they'll have smaller remote offices. I've talked with some individuals at the places like WeWorks, and you know, the smaller the smaller offices, the 1, 2, 3 man person offices are really shifting to the work at home model and giving up that space. There's a lot around there. That's a lot of pressure. And of course, residential. Residential, we still have a very high unemployment that is going to impact residential real estate. So I'd be cautious. I do think I would buy on a dip. I do think real assets is good in the long term. It does mean as more and more people can't buy or have to sell, it does mean more renters. Lower interest rates is good for real estate companies or real estate holdings. Inflation's not, but we're a couple of years off of that. So I do think that's an area. I don't think we're ready for that yet, but it's something to keep a closer eye on, is that area of the market. And then the last I'll mention on the real estate is the senior homes or the care homes. I'd be really cautious there, and that kind of blends into our last sector, is the healthcare. We're seeing, especially in Canada, government involvement, investigations into how they're run. What COVID has certainly exposed is some systematic problems in the operation or the organizations. That doesn't mean they're bad, doesn't mean there was wrongdoing. It just means there's a lot of changes. It's going to mean increased cost. It's going to mean less people using them. I'd be very, very cautious around that area of the market. And the last one I don't have on here is energy. You know, oil and gas kind of falls into energy. But I think one area also of opportunity potentially is alternative energies. We are seeing more interest from a lot of countries, more push as governments spend money to recover from this, to put some of that money or a lot of that money towards alternative energies or clean energies. So definitely keep that in mind. There is going to be a balancing act in that sector between its slightly higher costs versus the cheapness of, say, oil and gas or fossil fuels, especially at the current pricing levels. But as I said, the governments are around some of these stimulus packages are pushing more and more for that. So I would keep that in mind as well. So let's take a look at some of the companies. Let's take a look at Canada, and we're certainly going to look at blue chips. I think there's a lot of great value in blue chips. That does not mean that smaller companies or not indexed companies are a bad deal or don't offer opportunity, but I do see a lot of opportunity around the blue chip. And when I say blue chip, I mean the larger capitalized companies in Canada. You know, normally blue chip, we might think in banking industries in Canada. But I like to look across all the sectors, and I like to look at the front runners in each sector, as opposed to just looking at just the largest companies in Canada. So, you know, in that energy front, you know, there's Fortis, of course, we're all familiar with them. On the utility front, there is the banking sector. We can't ignore that. TD and Royal Bank are at top of the list. Enbridge, again, on the energy pipeline side of things. BCE would fall into technology or utility. TELUS is on the list as well. I think they're both really good in the sector. CNR, that's your supply chain. You need that. Your goods have to move. And Canada is a big country, so there's a lot of opportunity there. On the energy front, Suncor, I've talked about Suncor even before COVID. It's one of our larger ones. They have a great balance sheet. Yes, they're going to hurt. I haven't looked at their pricing today, but I would buy on a pullback. I wouldn't buy on a rally. There is going to be volatility around that sector. But as we see consolidation happening, Suncor will be a benefactor in that area. Pipelines, Pembina offers, you know, a great value. We usually talk about Trans-Canada Pipeline or IPL being a smaller one. I like Pembina as far as the value in that space. TELUS, I mentioned. I think the real forefront of bandwidth. As we all stay at home, we all download movies more or download TV. You know, they're a benefactor here in Canada. Real estate, RealCan, I think is a really good company. You know, neck and neck there, as well as First Asset on the REIT front. Keep an eye on those. Again, I don't think it's a buy yet, but it's something to keep in mind. Allemand Couche-Tard is kind of the grocery or convenience store grocery chains in the Eastern Canada or Quebec East. Offer a great value, great dividend, and just well supported all around. And again, CP Rail, that supply chain. I think you can look at any of these companies and really see a lot of value. Again, buy on the dip. I do think we're going to see some volatility through the summer. I think these are going to be great areas in the market. Again, not advice. Have to look at your portfolio, have to look at what your goals are, but these are good names to consider. Do some research or contact us for more information as to how they might fit into your plan. And lastly, on the US front, here's where we see more tech heavy. Canada doesn't have a really strong tech sector. You know, I could have thrown Shopify in there. I just think it's really, really overvalued after such a massive run this year. But in the tech sector in the US, we got Charter Communications. So I've based this off of FactSet, which is a research system. Goldman Sachs has a criteria that they look at for their top 10 projections. And this is earnings shares per growth. Anyone who knows me, I love earnings. I like cash flows is king always with companies. And if you're growing your cash flow, your company is healthy. So these are the top 10 with the top 10 projected cash flow growth over the next year based on that research. Charter Communications got an 88% projected cash flow growth. So this is broadband delivery tech company in the US, you know, your BCE, your TELUS type of provider down there. Netflix, of course, we all know, as more and more people stay home, and also looking for a cheaper alternative to cable, and that trend's been going for years. It's just been accelerated through this. Exxon would be the US version of Suncor. You know, looking at that energy sector or that oil and gas sector, really look for a good dip on that before buying it. That would be my advice. Facebook, again, in the tech sector, you know, they've got a good business model. They got a good revenue model. I'd be a little cautious at the current pricing. And again, I would definitely look for that pricing of the drop in ad revenue. Bristol Myers in the US on the pharmaceutical front. You know, we talked about that pent-up demand. Adobe technology, this is more work at home technology. More and more people using the electronic paperless environment. Amazon.com, of course, people shopping. NVIDIA, again, on the technology front, looking at a 26% growth. Fiserv and Qualcomm, both technology companies again, looking at the 5G technology, all great names to consider how they could fit into your portfolio. So again, contact us and really see what your diversification looks like and whether it's any of these names might fit in. Don't take this as a list just to go by. Again, it's part of a diversified portfolio. These are just names to consider if you're looking at moving some cash. And again, buying the buy point, although we're not market timers, I would look for a dip before I jumped into any new positions or added to current positions, as there is a bit of overvaluation in the markets. That's all we have for today, and I know I made this one a long one. I guess I'm making up for last week, which was really short, because of course we had Tony Dwyer, our chief U.S. analyst, talk last Wednesday morning on a special webinar that is recorded, and if you'd like the link for that, if you missed it, Tony's always a great listen, especially if you want a deep dive into the U.S. economy. So do reach out to us for that. Happy to get that over to you. Again, if you have any suggestions or things you'd like to see in these weeklies, or even our Friday deep dives, again, feel free to reach out to us. We have a new feature on mikeonmoney.com. You can actually book an appointment directly with us, directly with me. You can click right on there and get access to my calendar, find a time that works for you, and just put it in there. There is a box there to say, give us a bit more information to prep for the meeting. So if there's specific topics you want us to review or be prepared for, just plug that in there and be happy to have a chat to you about that. And always stay safe out there. We look forward to seeing you and talking to you next week, but we are around. As I mentioned, we'll be in the office 1 or 2 days a week going forward. So look for us coming to you from there in the not too distant future. With that, I'll let you go. Enjoy your day and stay safe out there. Thank you, everyone. Talk soon.